Commerce with Dr. V, the best pricing platform for learning online. Class 11th, Subject Accountancy. Chapter 1, Introduction to Accounting. Topic, Objectives and Functions of Accounting, Users of Accounting Information. For our Android application, you can scan the QR code visible at the right side of the screen. We have launched our website supported with by Class Plus app, and our exclusive YouTube channel Commerce with Dr. V is available. You can like, subscribe, and share the videos, and don't forget to press the bell icon. So thank you so very much for joining this class. Let's start. So the topic is objectives of accounting. So let's start with this objective. Okay, just a minute. Yeah, the objective of accounting is something which is related to the record keeping. But the objective of accounting is not just record keeping; it is much more than that. But to arrive those objectives which are more than record keeping, let's start with the same first objective, that is record keeping. Record keeping means to maintain the systematic tracking of all the transactions which are recordable. You know very well that only financial transactions are recorded, and the transactions which are not financial, they are not to be recorded in accounting. What does this mean by financial transactions? The transactions which can be transactions which can be termed into money, which means that you can express, if you can express any business transactions in terms of money, then that transaction is supposed to be known as financial transaction. So only the financial transactions are recorded, and record keeping is the first objective, which is something related to systematic tracking of all the transactions. Tracking means when which transaction happened with the date wise, the record should be there, systematic record should be there. The strategic importance of this objective is it ensures completeness and accuracy. All the business transactions are recorded, so complete information is maintained, and that too is with accuracy. So this was the very first objective, and let's move towards the next objective. The objective is second objective is profit or loss determination through income statement. This is done through income statements. What is the amount of profit or loss? Through preparation of income statements. Income statements, you know that at the end of year, the trading and profit and loss account is prepared. Trading and profit and loss account is prepared, and this is known as income statement. Its strategic importance is this, that it helps assess performance and growth. uh, is the performance of any organization is good or not? It is determined by the amount of profit it has earned, and if the organization is earning more and more profit year after year, then it is called that the business is growing. So this was the second objective. The third objective is financial position, determining the financial position through balance sheet, because the balance sheet shows assets and liabilities, quantities as well as the qualities of assets and liabilities both is shown through balance sheet. And balance sheet is used for the purpose of credit acquisition. It means if you want to borrow some amount from any financial organization, say it is a bank or any non-banking financial institution, then ultimately for the purpose of borrowing any amount, you need to submit your balance sheet so that the organization lending to you would be in the position to assess your financial position. Financial position of any organization is assessed on the basis of the quantity and the quality of assets and liabilities both. So there are investors who want to take who want to invest in your business organization, and the amount they have, they if they are intending to invest the amount in your business organization, ultimately they need to go for the research. uh, Before investing the amount, they need to know about the financial position, and that is determined again with the quantity and quality of assets and liabilities of your organization. On the basis of this information, they decide whether to invest or not. And yes, of course, managers perform different kind of planning of the business activities through uh, exact determination of assets and liabilities. One asset, for example, is cash in hand. So cash in hand is the amount, whatever the amount you have will be the basis of the planning, cash planning. How much amount you are going to spend on what activity is something which is related to planning of cash. So whatever the amount of cash in hand you have at your business will become the basis for cash planning, right? So the fourth objective is information sharing. Information is shared with the internal and external users that we will discuss later on this in this class today. So we are not going to discuss it in detail, but ultimately the information sharing is the another objective of accounting information. Internal and external users, they are shared with this particular accounting information. This drives transparency and trust. Transparency means no information is hidden. Every important information to any user is fully disclosed in accounting, and this generates the trust. Okay, the fifth and the last objective is legal compliance. It means the company has to follow different laws. One law is Companies Act 2013, and different tax laws are there. GST notification, GST guidelines are there. So to fulfill all the legal formalities related to different taxes and different laws applicable on any business organizations, you need to maintain accounting records. If you are doing so, then ultimately you can avoid penalties, and ultimately this legal compliance will ensure good governance of your business organization. So critical thought about the objectives of accounting is accounting isn't just for accountants, it is for the CEOs, the investors, government, and even for the public. This critical thought is very much you know easy to understand. Now let's focus on the second and the fourth topic of the chapter, the functions of accounting. So what are the functions of accounting? Let's know it one by one. The first function is identifying. Identifying what? Identifying the transactions which are of financial nature. So you need to first of all recognize the financial transactions. I have already discussed you the transactions which can be expressed in terms of money. They all transactions are known as financial transactions. So you have to first of all recognize the financial transactions, and this will ultimately filters the relevant data from the irrelevant data, right? The second function is measuring. The financial transactions are supposed to be assigned with some monetary value. It means how much money, how much amount, what is the amount of the financial transactions you have identified in the first function is determined in the second function of measuring. Here the monetary value is assigned to the business transactions identified in the first function. So this makes non-quantifiable events miserable. There are some events which are quantifiable, but yet there are some events which are not quantifiable in kilograms or millimeter or uh, milliliters. Ultimately they can be expressed, they can be quantified in terms of money. So by assigning monetary value you can make the non-quantifiable events as quantifiable in money. So the third function is recording. Whenever you have recognized the financial transactions, you have assigned the monetary value. It means the amount of that particular transaction is determined in the second function. The third very important function is recording. This is done in the journal book, and the recording is called as passing the journal entries. Okay, this forms permanent records and legal evidence. Here legal evidence means these journal entries, these journal records can be presented in law court of law to prove any point in the courtroom, and you can win or lose on the basis of these evidences. These are the proof, okay, that can be used to justify, to defend your point. The fourth point is the fourth function is classifying. Classifying is done in the ledger book, in the ledger book, and this is known as ledger posting. This task is known as ledger posting. Ledger posting, and posting enables the clarity and reporting. It makes reporting possible. So before reporting you need to summarize the ledger accounts. Okay, for the purpose of summarizing you need to prepare financial statements. The financial statements contains two parts. One is trial balance, one is trial balance, and the second part is final accounts. Okay, final accounts. The final accounts are prepared on the basis of ट्रायल बैलेंस. तो सबसे पहले ट्रायल बैलेंस बनाया जाएगा और फिर फाइनल अकाउंट्स बनाए जाएंगे. This consolidates big data into useful information. It means there are number of thousands of accounts, and you cannot go through all the accounts uh, in a single site. But if you have prepared trial balance, you can have all the records of each and every account in just a single site. Okay, so this is a simple sheet. Okay, trial balance. It's prepared in the form of a statement. And final accounts basically they final accounts have two parts. One is trading and profit and loss account, and second part is balance sheet. Okay, we have already mentioned the two. Trading and profit and loss is known as income statement, and balance sheet is the statement which determines the financial position of any business organization. So this financial statements is the preparation of financial statements. This comes under the function of summarizing, right? And the business value of this function is that it consolidates big data into यूजफुल इंफॉर्मेशन. बहुत भारी भयंकर जो भारी भरकम डेटा होता है उसको बहुत ही यूजफुल इंफॉर्मेशन में कन्वर्ट कर देता है. द सिक्स्थ फंक्शन इज एनालाइजिंग. Whatever the financial statements you have prepared, uh, the deep study of these financial statements is done, which is called as analyzing. For this purpose you go calculating different financial ratios, and you prepare different comparative statements. Okay, say as a comparative balance sheet, comparative income statements, etc. And the business value of this function is it informs strategy. It means it feed the strategy. It becomes the basis of strategy. Okay, and it identifies the risk. It means after analyzing the balance sheet and the profit and loss statement, ultimately you identifies the risk if there are any, right? The last and the very important function is communicating. It means you prepare reports and you send the reports to different stakeholders. The one stakeholder are the owners, okay? Owners, owners, government, tax authorities, and number of stakeholders are there. You sends reports to the stakeholders. Okay, this builds reputation of the business organization, enables funding. It means you can get funds from different financial organizations and support from the public, the customers, the suppliers. So real world application of this the function of accounting is an investor might reject a company if its financial reports lack analysis. Here we are talking about the communicating. It means the reports which are prepared by the accountants, they are that important that any investor, he or she might reject a company if its financial reports lack analysis. If analysis is not done, then ultimately, even though the revenue is high, the investors may decide not to invest in that particular company. So you can uh, understand that the importance of analysis of financial information is much more than we considered. So this analysis is used while preparing the reports to be sent to the stakeholders. Okay, so the analysis is very much important because the analysis is shown in the reports sent to the stakeholders, right? So the topic users of accounting. Users of accounting, there are diverse stakeholders and they have diverse needs, different needs. Different stakeholders, they have different needs. So let's know who are the different users. Internal users are the owners or the managers, and you can also write here employees. Okay, employees, they are also known as the internal users. Owner are those person who have invested their capital into the business and they are the owner of the business. They need to know about the profitability, the amount of profit they have earned during any particular accounting period. Managers, they have to justify their salary. They need to earn the minimum amount required and to justify their salary. And implies they are also interested in the knowing the amount of profits. Ultimately, if the profit is much more, then they will be able to get more bonus, more incentives from their managers. Okay, so owners are interested in knowing the profitability. Managers, they have to prepare different strategy, and employees, they have to uh, perform daily operations every day. So they need various information. External users are investors who invest money in the organization. Lenders, who whom you borrow the money. Okay, the banks, the different non-banking organizations from you get money, they are the lenders. Government investment safety. Actually, governments, the basic concern of government is to safeguard investors or the public from the malpractices done by different companies. Okay, that's why government investment safety is there. They want to know that whether the company is doing everything fair, or it is going to uh, you know uh, utilize the money of the business, the money of the investors in the wrong way. Okay, legal compliance is done or not. It is also something which is related to the government officials. They are interested in knowing each and every activity, and this can be determined by the accounting information. There are tax authorities, tax collection officers are there, they want to know what is the exact amount of income and the property, so they can decide the tax liabilities on the income and the properties. Okay, so strategic insight of these users, basically internal and external. Different users use the same data for different purposes. This requires accounting to be relevant. It means uh, whoever the user, they that particular person need different kind of information, so the accounting information needs to be customizable as per the need. The accounting information should be understandable. It means clear. They should not be doubtful. Ultimately, if the information is not clear, then ultimately that will create confusion. And reliable, the information should be fair and true. If it is, then it would be reliable. And whether the information is fair or true or not, if the information is verifiable, it means if there are evidences, if there are bills, if there are vouchers which can prove any journal entry to be as right, then ultimately the accounting information would be called as reliable. Okay, so the quality of accounting can affect market confidence. If the quality of accounting is not good, then the market confidence is not would not be more. If the information is qualitative, then the market confidence would be high, and that will increase the share price of your organization, and the business will not only survive but also grow in the long run. Okay, so hope you have understood all the topics of the day. And again, my request to all of you would be that keep watching, keep learning, because we are coming to your doorstep through online teaching. So you are supposed to be much more regular and sincere, and hope so you are. So thank you so very much for watching. uh, Keep on sharing the video with your friends. Thank you so very much. Thank you. Thanks a lot.